Every time you buy a cup of coffee or a new laptop, a fraction of that price goes directly to fixing your local roads and funding your schools. Sales taxes are destination-based levies, meaning the money is legally owed to the state and local governments where the final consumer actually lives. For decades, this entire revenue system was governed by a single geographic standard known as the physical presence rule. The logic was straightforward. A state government could only force a business to act as its tax collector if that company had an actual footprint inside its borders, like a brick-and-mortar storefront, a warehouse, or an office full of employees. As long as commerce required a physical building, state borders successfully contained and tracked the flow of retail goods. Local infrastructure remained reliably funded by the businesses operating within the community. Then the internet arrived. A retailer could set up a server in one state and ship millions of products across the country, bypassing physical buildings in the states where their actual customers lived. Because these online companies lacked that physical footprint, they were not required to collect local sales taxes. This created a significant pricing advantage, allowing digital retailers to undercut the local shops that still had to charge tax at the register. State governments quickly found themselves losing billions of dollars in required public funding. At the same time, local business owners faced a competitive disadvantage simply for operating a physical store in their own neighborhood. The rapid adoption of e-commerce simply outpaced the existing tax code. By decoupling retail from physical locations, the internet effectively created a gap in state revenue that widened as more commerce moved online. To stop this loss of revenue, South Dakota deliberately passed a law designed to challenge the old physical presence rule. They demanded that out-of-state online sellers start collecting taxes on goods shipped to their residents. The major online retailers fought back, and the dispute escalated to the highest legal authority in the country. In 2018, the Supreme Court heard the case, South Dakota v. Wayfair, Inc. The court ruled in favor of the state, officially striking down the physical presence requirement. The justices acknowledged that tethering tax liability to brick-and-mortar buildings was insufficient for a modern digital economy. With one decision, the highest court closed the internet's primary tax advantage, requiring online commerce to operate under the same tax collection standards as local shops. To replace the old geographic boundaries, states adopted a new legal concept called economic nexus. Instead of looking for a physical building, the law now looks at a company's financial footprint. This shows how an economic nexus is triggered. Following South Dakota's model, if an out-of-state business delivers more than $100,000 in gross sales to customers inside a state, or alternatively, if they complete 200 separate retail transactions within that state over a year, they are instantly responsible for collecting tax there. Virtual reach and transaction volume became the new triggers for tax liability. Once a business hits these target numbers, they are legally required to register and remit taxes in that state. This shift created a massive administrative challenge. Suddenly, a small merchant selling items out of their home had to track fluctuating tax thresholds and remittance laws across 50 different states. To manage this, states implemented a secondary legal solution. They shifted the burden of tax collection away from most individual sellers and onto marketplace facilitators, the platforms like Amazon and eBay. The mechanic works by intercepting the transaction. If a major platform facilitates a sale between a buyer and an independent seller, state laws force the platform itself to automatically calculate, collect, and hand over the tax. State governments recognize that it is more efficient to regulate a few large tech platforms than to audit millions of individual internet sellers. To see how this system impacts an individual seller, we can look at the enforcement rules in the state of California. California's rule is clear. Anyone actively engaged in selling physical retail goods is required to hold a valid seller's permit, also known as a reseller permit. Ignoring this requirement carries immediate financial consequences. The state will hold the seller personally liable for all uncollected taxes, add civil penalties, and can officially revoke their legal right to buy wholesale goods. The state can also pursue criminal charges. Operating without a required permit in California is a misdemeanor, an offense punishable by fines and potential imprisonment. California's tax authorities treat online selling with the same weight as any other professional business. To ensure every transaction is taxed, they back their requirements with the same criminal and civil enforcement used for established retail corporations. The law does offer a specific exemption for many independent merchants, known as the marketplace exception. If every single item a merchant sells goes through a registered platform like eBay, that platform's compliance shields the seller. In California, you generally do not need a personal seller's permit if the facilitator is already collecting and remitting the tax for you. But there is a catch. The moment that merchant makes a direct sale, whether through their own website or in person, they lose that shield and are immediately required to register with the state. The transition to digital retail didn't eliminate the need for tax revenue, it just changed who is responsible for the collection. Whether through a major corporate platform or a personal permit, state governments have ensured that every transaction remains part of the tax base.